But your first guest today says, don't be deterred. He thinks the S&P 500 will power up next year all the way to 7750. Let's start off a big day with Julian Emmanuel, Senior Managing Director of Equity Derivatives Quantitative Strategy at Evercore ISI. Julian, welcome. One day doth not a trend make, but do you have a take on what's happening today?
Well, this is a classic buy the rumor, sell the news, right? So the market turned last Friday on anticipation of the government reopening. And essentially, if you look at it, basically somewhere plus or minus when the president signed the bill to reopen the government last night, we peaked. And frankly, when you think about it, the expectation was that you would have uncertainty resolved. And lo and behold, if anything, uncertainty has intensified a bit more, given the fact that there's an opaque aspect to whether or not we're going to get October economic data, how we're going to get it, what form we're going to get it. And the net effect of all of that is it's actually made it basically a coin toss whether the Fed is going to cut rates in December. And given the run that we've had in high multiple stocks, that's a headwind in the near term.
Well, should investors care if the Federal Reserve cuts interest rates in December or cuts rates in January?
Well, look, for the bullish case, you would certainly prefer that they cut in December. It's also a function of the messaging. If the data is either not produced or not terribly clear, and it calls into question whether there's going to be a cut in January if there isn't in December. And for the record, Evercore ISI does believe that they do cut in December. It's just another layer of uncertainty that with the market trading at 26 times, uncertainty is definitely one of those things that is more difficult for stocks to digest here.
So give us the bull case. Take us, Julian, to 7750 next year.
Sure. The bull case really rests on this idea that structural bull markets like the one we've been in since the low in October 2022, driven by the AI theme, don't tend to end on valuation alone. The things that we'd be looking for are recession. There are few, if any, signs of recession. The second sort of element would be an adverse interest rate setup. From the perspective of the Fed, you may not get as many cuts as the market is pricing in right now. But the one thing we know you won't get, which was what killed the internet rally in 1999, was a Fed that was hiking. They actually hiked 6 times in the second half of 1999 to pop what they perceived to be a bubble. That is not going to happen, in our view, till at least the midterms next year. There will be no hikes, regardless of how the data sorts itself out. 10-year yields remain very range-bound. And for us, if you look at past bull markets going back 25 years, they've all had late-stage capital market surges, and we've certainly seen a pickup in deal activity in recent weeks and months. But frankly, compared to the prior peaks in 2021, 2007, and 1999, we think there's lots more to go. That is the prop against a Washington that will likely continue to be providing liquidity, monetary and fiscal. Those are the elements that get you to 77.